Namaskar, this is Akhilesh Bhargav. Welcome to Tit-Bits on Business and Finance with me. The festival season sales of Diwali and the resultant short-term boost to India's economic recovery are over, and the uncertainty about our growth rate is certainly back. India needs rapid and long-term growth in order to pull its millions out of poverty and get itself out of the rut of being called what is known as a low middle income nation. If the government today is happy and boasting about a 9.5% GDP growth expected this year, then that to us is not an impressive benchmark to set for ourselves. After all, this 9.5% growth rate is based on the 7.5% contraction of the Indian economy that took place last year. And even at an estimated growth rate of 9.5%, our economy will still be below the pre-pandemic levels of March 2020. Moreover, the Indian economy's recent growth has been driven more by corporate profits than on account of demand fueled by wages, and that is very evident from the rising unemployment. And this growth has also been driven by large firms rather than by small ones, showing that the present recovery in the economy has not been broad-based and that it is confined to a very narrow vertical. What we badly need today is durable long-term growth, which is possible only if it is supported by growing domestic consumer demand. That is because if consumer demand goes up, then India's capacity utilization will shoot up from the present low of just about 60 to 65%. And that in turn will trigger the virtuous economic cycle of capacity addition, capital expenditure, which will lead to additional jobs. That will ultimately fuel consumer demand and will generate long-term growth in India. We need investments in fresh capacity to build jobs which will generate demand. It's a cycle where each feeds into the other. As per the Reserve Bank of India itself, an investment cycle in India lasts for about 12 quarters, with 7 quarters of a rising investment rate, followed by 5 quarters of an investment downturn, only to be revived thereafter again. So you have about 7 quarters of an uptick in investment, 5 quarters of no uptick, and then the cycle starts all over again. India has now witnessed the longest period of weak investment activity in several decades. Investment by the private sector has now been languishing since a decade, and corporates have preferred to repay their existing loans rather than take new ones in order to build further capacity. If capacity utilization remains at 60 to 65%, why will they add to further capacity? The CEO of Axis Bank thinks that revival of the investment cycle in India is still 9 to 12 months away, and that is reflected in the lending patterns which we are seeing across the board. The recent data says that while non-food credit increased by 6.8% in September, the loans to the industries went up by only 2.5%, despite the fact that banks today are sitting on surplus funds of over 7.5 lakh crores. Industries are not willing to borrow. Loans to corporates remain sluggish mainly because of underutilization of capacity and deleverage of companies. And the muted credit demand has thus forced public sector banks to cut their growth guidance for the corporate loans for this year by 100 to 200 basis points. The Reserve Bank data shows that loans growth at present is driven by retail and consumer loans and not by corporate loans. Lending by NBFCs by way of consumer loans has shot up by 58%. Commercial vehicle loans by them are up by 31%, and auto loans by NBFCs have gone up by 40%. But productive loans by way of secured business loans, equipment finance loans, etc. have shrunk, showing that India's capital expenditure cycle is still in the negative territory. That is confirmed by the CMI data, which says that fresh investments in value terms fell by 54.9% in the second quarter of the current financial year as compared to the same period last year, and it fell by 55% as compared to the same period in financial year 2020. The fact is that the very confidence to invest, whether by way of one's own funds or through borrow funds, is missing in the private sector, and both the bankers as well as the entrepreneurs are unwilling to risk their capital in new projects in fresh capacity. Till such fresh capex does not take off, we will not see rapid and long-term growth in the Indian economy. That is the reason why the finance minister has been exhorting the investors to invest, and the prime minister has been asking the bankers to lend in order to kickstart project investments in India. At a recent CII summit, the finance minister, while addressing the industrialists, she said, take advantage of the opportunities presented by Atmanirbhar Bharat, be a lot more risk-taking, she said, and she asked them to create capacity to bring more dynamism to the economy. She asked them to ramp up capacity, create job opportunities, empower people with skill sets, venture into new areas, and find partners to upgrade themselves technologically. The finance minister then appealed to the industrialists not to further delay increasing their capacities and to not further delay looking at areas to partner in technologically, upgrade themselves, and get into new markets. Mrs. Sitharaman asked corporates to offer jobs to reduce income disparities, to cut down on imports, and to ramp up investment in manufacturing. She assured the industrialists that the government's intention is to make the business landscape easy and facilitative. According to the finance minister, startups and new age technology will make a big difference to the economy as we are seeing at the moment. She said that a spike in consumer demand suggests not just pent-up demand, but according to her, it suggests that life is getting back to normal in India after the crisis of unprecedented scale that India witnessed. The message was invest, add to capacities, and ensure that more jobs are created, apart from ensuring that they get into more technology value added items and segments. While the finance minister appealed to the investors to invest in new projects and capacity build-up, the prime minister, on the other hand, asked the bankers to proactively lend for such investments. While addressing a conference on creating synergies for seamless credit flow and economic growth, Prime Minister Narendra Modi said that banks must support wealth and job creators. The Prime Minister said that the need of the hour is that banks must work proactively in order to boost what he called the wealth sheet of the country with their own balance sheets. In other words, he said that the bankers must lend. He asked banks to support startups and said that they must shed the culture of the customer being the applicant and the bank being the approver. He thinks that that culture is not correct and that the banks must go out and lend without treating the customer as somebody who applies and the bank treating itself as the one who approves. According to the Prime Minister, the banks need to shed the impression that they are the givers and customers are the recipients. And they must, he said, instead have a partnership approach to create wealth and jobs, boost the economy, and achieve self-reliance. The Prime Minister asked banks to serve customers proactively and give them customized solutions after analyzing their needs, something that the banks do attempt but doesn't happen very often. He said that banks play a major role in making projects viable through their support, through their expertise. He further said that honest decisions of bankers, if gone bad, will be protected and that bankers should lend without any fear. The Prime Minister pointed out that reforms had addressed the challenges in the banking sector and that the financial health of bankers today, of banks today, is in a much better shape. Banks, according to him, have sufficient liquidity, bad loans are at their lowest, and banks, he said, are strong enough to play a major role in imparting fresh energy in the nation's economy and give it a big push which is badly needed. The fact of the matter is that projects take off when funded by equity and by debt, which come from the promoter investor, and of course, they also come from the lending banks. The promoter puts in the equity, the banks put in the loan, and that's how a project's financial structure is generally combined. The fact is that today, both are sitting on the fence. It is easy for the finance minister and the prime minister as leaders to ask them to invest and lend, but it is their capital at stake, and both, which is the borrower and the lender, have been exercising utmost caution, because of which Investments in new projects have been languishing since a decade and they are reported to be at a 45-year low. The reasons for this worrisome situation, where new investments are not taking off, where corporates too are sitting on money, but they are not willing to risk it in further capacity, further projects, are many. And let's look into them. The first is capacity utilization remains low today because of weak consumer demand. And that has been because demand is afflicted today by joblessness and loss of livelihood. Capacity utilization must touch about 85% before it is time to invest in further capacity. It is today just about 60 to 65%, which explains the unwillingness of the companies to invest in fresh and additional capacity. The second is that much as the Prime Minister may assure bankers to lend fearlessly, they yet remain a scared lot. The incidents like the recent arrest of the former State Bank Chairman Pratik Chaudhary long after he had retired only worsens the situation. The lending norms too have been tightened so much that it has not been easy availing of loans from banks, thus impacting investments in new projects. Further, merely because the interest rates are low, that does not mean that corporates will borrow and they will invest in new projects. Apart from the poor consumer demand, the oppressive ease of doing business in India and the high cost of doing business also certainly discourage entrepreneurs from risking their capital in new business. And when the entrepreneur is not willing to risk his equity, the bank, of course, is not going to risk his own money. With the corona scourge still on the horizon and the economy having faced many years of a downturn, a sense of confidence about the future, the confidence about the financial situation of companies, borrowers in future is missing, and they are thus not eager to invest. If the private sector is unwilling to invest in capital expenditure, so has been the government, despite its promises to do so. The government actually needs to set the example for the private sector to emulate. And when that happens, the private sector too will start investing perhaps in a bigger way. Let the government start investing. Let the government invest in capital expenditure in a big way. And perhaps the private sector will get the confidence to follow suit. It is good that as leaders, the Prime Minister and the Finance Minister talk about ramping up investments in the country, about exhorting and encouraging the investors and the bankers to do so. But that's not going to be easy. The ground reality is still not the supporting one. This is Akhilesh Bhargav signing off till we meet again. Namaskar.